Thank you, Masood. Let's now turn to Scott Morris. He's a senior fellow at the Center for Global Development, and he'll tell us a little bit about what we can expect from the World Bank. What could the World Bank be doing in this space along with the rest of the regional development banks? Thanks, Scott.
Thanks, Amanda. So yeah, I want to spend my time essentially building on Masood's remarks around the multilateral development banks and explaining this dollar figure that my fellow panelist Nancy Lee and our colleague Clemence Landers came up with, which sort of sets a headline number of $1 trillion when it comes to collective MDB response. So I want to sort of break that down a little bit, but just to put that in a little bit of context and building on Masood and Brad's remarks, I think it is if side, it has been more of a bottom-up approach. They sort of identified here are the things we want to do, and here's how much we can spend on those things. I think we have to start by acknowledging that there's a huge amount of uncertainty about the months ahead in terms of need, but also how to spend the money and how to do it in a way that meets the crisis needs. And that's going to take some time to work through the complexity of particularly in low-income countries, how do you get money to where it needs to go quickly? But we shouldn't wait on that to be able to identify sort of the envelope of financing that is possible. And I think even that kind of announcement has an important near-term effect. And I think, which is why we did the exercise of trying to identify an envelope for the MDBs, because I think particularly for bodies like the G20, it really is an important aspect of their statements that they begin to put some big numbers, frankly, in what they're committed to doing, and particularly working through the IMF and the MDBs. I think it provides the necessary reassurance to the borrowing countries about what they can have available to them as they do their planning, some reassurance to private markets about a backstop that will exist for these countries. So I think it is an important element of it, even if, frankly, we don't know exactly how it's going to be spent at this moment. It also helps, I think, frankly, when you consider a body like the G20, so basically wealthy and large economy countries that can effectively sort of make decisions for these multilateral institutions, you do have to work through the politics of a lot of this. And I think it's important early to get them on board with sort of maximalist thinking about scale of financing so that we don't have sort of these sort of slow iterations and incremental shifts to, we have to go bigger, we have to go bigger. Much better that they start from the standpoint of a big number. So our $1 trillion estimate, let me try to break that down a little bit for the multilateral development banks. And just to be clear, we are talking, first and foremost about the World Bank, the largest of these institutions, but there are also a handful of core regional development banks that we add to our estimates that, we do expect to act in a coordinated fashion, particularly in crisis moments, and we saw that with the global financial crisis. So what we wanted to try to understand is, let's set aside sort of normal conditions and the lending standards that these institutions have, which are largely a function of making their own lending as cheap as possible, which depends on their own AAA ratings on their bonds. And to do that, they have what everyone would agree are frankly very conservative financial policies, and they rely on essentially equity to loan measures of what their lending should be. And critically, that definition of equity is strictly defined around the capital that their shareholders have paid into the institutions over the years and the reserves that they have on hand. Now, that so that defines what is possible in normal times. And if you look at the MDB system as a whole, current exposures are something like $500 billion. We then say, actually, if you look at the statutory limits of what these banks are allowed to lend, that number does jump to $1 trillion pretty easily. So how do you get there? Basically, if you look at the charters of the institutions themselves, the charters say that essentially outstanding exposures, outstanding loans cannot exceed the total capital and reserves of the institutions. And here the total capital is the important concept, because total capital is that paid-in capital, but it is also something called callable capital that exists for each of the institutions, and in fact exists as a much greater share of total capital than the paid-in. So what is this callable capital? It is essentially a commitment by the shareholder countries that in the event the MDB itself is unable to service its debt, the shareholders will pay in additional capital to the institution, and that is specified in actual dollar amounts that is defined in each of the rounds of capital increases that the banks have had over the years. So you essentially have sort of a standing stock of this callable capital that is on the books. There's frankly a fair amount of complexity to a call on capital. I think what is important to emphasize here, though, is that in recognizing the value of this callable capital, it is by no means suggesting that there's going to be a call on the capital. And I would argue to be, even in the environment, the highly uncertain environment that we're facing, it would be the worst kind of doomsday scenario that would have this kind of call, because ultimately the value of the bank's own bonds is directly tied to sort of the position of its largest shareholders, their ability to finance themselves. So really, it is not a dramatic step in a crisis environment to recognize that callable capital exists. It does exist, and to lend with that understanding. And again, I would emphasize that we are still far removed from a circumstance where the banks are unable to service their own debt, and they would have to proceed with these kinds of calls for their shareholders to step in and provide more capital. So with that kind of recognition, that does get you to what we would call the legal limits of MDB lending, given their current resources of $1 trillion and more. I would argue that we actually sort of set the lower end of a maximalist lending approach, in part by defining as probably a smaller number of institutions than one could define. We did not include, for example, an institution like the Asian Infrastructure Investment Bank, some of the other regional institutions that have historically not been defined as the core, but do have the ability to lend. A couple of other points just to close on this. One is that I would say, this is really defining near-term capacity. I think it is important to recognize, as we saw with the global financial crisis, that with a massive ramp up in lending from these institutions, at some point, whether it's 2 years from now, 3 years, you then have to answer the question of, okay, what does normal look like again? Where do we want the banks to be in their lending outside of a crisis period? And are we even outside of that crisis period when it comes to a lot of the borrowing countries? Because it is the case that lending at these levels won't be sustainable. So there's either some scaling back down, or it will be a moment when the shareholders do have to step up again and be willing to put additional capital in the institutions, as they did in the years following the global financial crisis. It's always important to emphasize with these capital increases that that paid-in capital number is actually quite modest for the shareholders in the scheme of things. as much as it can be leveraged to sort of dramatic levels where you go from billions to trillions, the actual paid-in capital is fairly modest in size. So even if we are facing a moment a couple of years down the road of more capital increases, that should not panic anyone. I think it's the normal course of business, and particularly if it's happening at a point of recovery for the large countries. Last thing I will say is it's also important to recognize terms of financing and types of financing coming from the MDBs, because what we did in our exercise was sort of define the full envelope. It's really critical to understand different financing needs of low-income countries versus emerging market countries. Concessionality matters, perhaps less so in a crisis where there's a greater emphasis on overall scale of financing quickly. But the point about concessionality and the terms of the World Bank that go to low-income countries, which are zero interest rate, very long-term loans, long grace periods, that ultimately does depend on the willingness of donors to continue to provide support. So you have these ongoing rounds of replenishments of the bank's funds, but it seems to me that any donor response to this crisis will entail some increase in contributions to these institutions to subsidize the lending for the poorest countries. I will, with Amanda's promise, we'll come back to debt relief, so I'm not going to say anything more about that. I think Brad teed it up well, and I think it is important to come back to that, to think about how does debt relief sit alongside direct financing and sort of in the landscape of creditors, with the MDBs being a critical set of actors. How should we think about that? So I'll stop there. Thanks.
Thanks, Scott. And now let's go to Nancy Lee. She's a senior fellow here at the Center for Global Development as well, and she'll talk a bit more about development finance institutions and their role, as well as how she sees the outlook. Thanks, Nancy.
Thanks, Amanda. I will then pick up, I think, on two pieces of this conversation. One is the plight of low-income countries during this crisis, and in addition, talk about the private finance arms of the development banks. So first of all, for all of the reasons that Brad enumerated, this time I think is going to be very different for low-income countries than the global financial crisis. They're entering this very dangerous period with much higher debt levels, much more integrated in the global financial flows, and therefore they're subject to all of the crisis transmission channels that Brad mentioned, including a sudden stop in capital flows, which we are certainly seeing in emerging markets. So as both Masood and Scott alluded to, the development banks are going to have to step up for low-income countries in a way that they really didn't have to step up in the global financial crisis. During that period, World Bank lending to IBRD countries, the higher income developing countries, increased by about 140% in the period immediately after the crisis. The increase in lending to IDA countries was much less. It was about 50%. So this is not a question of either or between middle-income countries and low-income countries. It's both, and that's one of the main reasons that the numbers that we're all talking about are so big. Low-income countries are going to need fiscal packages of large size, just in the same way that other countries need them. In a low-income country, a collapse in income due to this kind of crisis is a collapse in consumption, and particularly for poor people. So fiscal packages are essential. We've done some rough calculations, and we come up with a number for all IDA countries of the kind of additional spending needed that could reach something like $200 billion. So that's a big part of the larger numbers that everyone is talking about. Now, turning to the development finance institutions that do private finance. So what's now a health and an economic crisis could very easily and very likely turn into financial crises in developing countries. Their banking systems are vulnerable to sovereign debt servicing problems because they hold a lot of that paper usually. They're vulnerable to rising non-performing loans. They're vulnerable to currency volatility. So an extraordinary effort here is not just needed for the arms of these institutions that lend to governments. It's also needed for the parts of the institutions that lend to the private sector. So we can look back at the previous financial crisis, and the record, I have to say, is pretty mixed. If you look at the independent evaluations of their performance, some of them were pro-cyclical rather than counter-cyclical. In at least one institution, lending dropped in the year after the crisis. Some of them were slow in getting their new initiatives started. There was, in some cases, a disconnect between the kinds of products they were offering and the kinds of products that were needed. Some had some success in trade finance, but as we've just heard, we're in an entirely different set of circumstances with a supply shock, and recovery in trade in the near term is very uncertain and probably unlikely. So trade finance can't be the focus, or at least the only focus of these institutions. So I think we need to learn the lessons of the last crisis. And let me suggest that these banks, through their private sector arms, are going to have to do some things that they didn't do last time, or do more of some things that they did very little of last time. Let me suggest 5 things in particular. First of all, I think there likely will have to be a shift in the composition of the products they offer toward more subordinated products, like subordinated debt or equity. Their bank clients are not just going to need liquidity or credit lines, they're probably also going to need capital to shore up their balance sheets. So these are high-risk kinds of products for these institutions, but if they aren't there, if the development banks aren't there, no one else is going to be there. Second, I think these banks, the development banks, are going to have to take a larger share of repayment risk to ease the burden on the financial institution clients and the firms that they serve. That, in many cases, means local currency risk. So a lot more of the lending is going to have to be in local currency this time around. Third, speed is critical. And I think rather than focusing only on new money to their private clients, I think these banks ought to consider something like restructuring their existing credits to provide near-term relief in repayments. And that, in some cases, can be done quicker than negotiating new money instruments. Fourth, they should think about ways to extend the benefits of their finance beyond the financial institutions and firms to the workers employed by the firms. So why don't they start thinking about rewarding borrowing firms, maybe ex post, for retaining workers on payroll? They could consider things like partial loan forgiveness or interest rates discounts if the firms to which they lend maintain the workers on the payroll. And then finally, collaboration. This is not a time for competition among the development finance institutions. Risks will be very high. Everything I've just talked about entails a lot of risk. It makes a huge amount of sense for these institutions to collaborate, to share risk, and to scale their finance. Just one last point, and that's about the shareholders of these institutions, which Scott was just mentioning. This is not just a moment for leadership by the management and the staffs of these institutions. It's a moment of leadership by the shareholders, in part through the G7 and the G20. We have not seen so far any clear guidance to these institutions with respect to how they should make these trade-offs between the very high risks in the balance sheet damage and the extraordinary ramping up of finance that we're asking them to take. So this is not a time for mixed messages from the shareholders. They got to be very clear about their willingness to tolerate some balance sheet deterioration in the near term. And in the longer term, I would say this crisis and the last one points up a common lesson, which is that there's really, you could argue, a piece missing in the global architecture, an entity which is capable of providing these subordinated products, taking a lot more risk, and accepting lower than market returns. And before the crisis, we proposed such an entity, and we called it the Stretch Fund, as a way to fill in this gap in the development finance architecture. I think the crisis itself only strengthens the case for developing something like this. So I would urge shareholders to take a look at this and work on creating something like this, not just for the current circumstances, but for all of the crises to come. Thanks.
Thanks, Nancy. I understand that we had some audio problems when we kicked off at the start of our session. So I'm going to ask, and apologies for this, panelists, and well, now the next event is going to be flawless, no worries. But can I ask Brad, if we could, Brad Setzer is a senior fellow for international economics at the Council on Foreign Relations, and he was talking very importantly about the role that the Fed has had in the initial response and why it's so important that the IMF and the other multilateral development banks come back in. Brad, can I ask you to do a short summary of your original comments so that we can make sure that they're reflected on the event? You're muted.
Brad, you're muted.
So the Fed can supply short-term financing in dollars through its counterpart central banks globally to meet short-term needs that arise amongst financial institutions that need to raise dollars to extend trade financing in dollars, financial institutions that need dollars in order to provide dollar hedges to a range of institutions. The most obvious are life insurers, who typically hold long-term U.S. corporate bonds and need to hedge the currency risk. That is the role the Fed can play and the role the Fed is playing. What the Fed really cannot do is make up for a shortfall in underlying reserves, make up for longer-term falls in private financial inflows, and make up for the loss in export income from commodity price shocks, from the loss in tourism revenue, and from the contraction in manufacturing trade. There are a host of classic balance of payments financing needs that have arisen in the global economy. Financing needs which are not needs for 90-day bank financing, but are needs for multi-year loans to countries that should have the capacity to repay but won't be able to repay quickly. And that kind of financing is what the IMF was set up to do. The IMF, with its quota resources, with the resources from an expanded or re-expanded new arrangement to borrow, and with the supplementary financing provided by its third line backup bilateral credits, can, I think, mobilize up to $1 trillion in new lending capacity. And it should use that to make up for the fall off in balance of payments inflows to emerging and low-income countries, and to allow countries to expand their budgets as needed to support public health and make income support payments available to those who have lost their jobs.
Thanks, Brad. And then, Masood, could you give us a short wrap-up of what you also said earlier? You talked about the importance of an aggressive approach by the World Bank. And I wonder if you could also add a bit of a reflection on the need for grant financing. That's a bit like IDA that we've discussed with Scott and Nancy for low-income countries, but outside of governments themselves, there's also need for humanitarian finance. Could you address some of those issues?
Sure. I'm sorry that we had the audio problem before, but so let me just say, kind of the first thing I do want to reiterate, and apologies to those who heard this before, is that this is going to be an unprecedented shock, much larger for the developing countries and low-income countries than the global financial crisis was. Partly because in addition to all the external shocks that come from lower commodity prices, lower trade, from lower finance from the private markets, there is a domestic supply shock that actually comes from the epidemic itself, which is still about to unfold in many, many countries. So I think it's just important to recognize that this is going to be a shock of a magnitude that we have not seen in many of our lifetimes. And consequently, it requires the same kind of response. The second point I want to make is to pick up on what Brad was saying, that this response for the developing countries and for most of the low-income countries has to come from the international financial institutions stepping up. Why? Because private markets are not going to be able to finance most of them. They will be much more risk averse in the period going ahead. In fact, twice as much money has pulled out in terms of portfolio flows from developing countries in the last 3 months than in the aftermath of the financial crisis. Secondly, they also do not have, many of them, the reserves themselves to draw upon. Some do, and they should, but for most of them, they need to get help. And that's why this is the moment for the IMF, for the development banks, and for other institutions to step up, official institutions to step up. The IMF has estimated the financing needs to be about $2.5 trillion. That is likely to be a conservative estimate. In my view, by the time we finish, we're going to end up with a larger number. But with their current financing, as Brad has said and as Scott mentioned, between the MDBs and the IMF, if they really go the whole way, if they step out of their comfort zones, they should be able to provide a substantial response in the near term. Now, two other things that I do want to say. One is that what does stepping out of their comfort zones mean? Well, one thing it means is to focus in the near term on the things that matter in helping countries deal with the crisis. Most emerging market developing country policymakers today are looking for help on how to spend the money most effectively. Should they scale up cash transfers where they can? Where they don't have those systems, what other ways are there to shore up incomes during the middle of this crisis? That's where the multilateral institutions can provide technical advice. So focus on that, not the time to focus on some of the traditional things that rightly these institutions focus on how to make the economies function more efficiently in terms of their public enterprises or their trade policy. A second way of stepping out of the comfort zone, a point that Nancy made. This is the moment for these institutions to provide non-concessional money of their own to low-income countries where this is needed to supplement the concessional resources that they have. Because even the non-concessional money from the IMF is 2 or 3% interest today. Same thing with the IBRD. That is a whole lot cheaper than the money that some of these countries have actually been borrowing, the low-income countries have been borrowing on commercial markets, which has got them into some of the debt problems that many of them face today. And the third important way in which they have to step out of their comfort zone is to recognize that some issues will need to be dealt with tomorrow rather than today. Today, if the priority is use the resource capacity you have, get the money out, help the countries to deal with the immediate crisis. Tomorrow, we will have to deal with what does this mean for the issue of debt sustainability and whether or not we will need some degree of debt relief in one form or the other by stretching out maturities or by providing outright write-downs down the road, that question will need to be addressed. Similarly, tomorrow we will need to address whether the capital base of these institutions needs to be augmented, whether or not we need to come back, as Scott was referring to this, whether we need to come back and provide financing, additional financing capacity to the MDB system to be able to deal with the beyond the crisis needs that they're going to have. But right now, my personal plea is for people to focus on using the capacity that we have, imaginatively and boldly maximize what we can deliver, and do not get entangled in the next few weeks or months in a conversation that is going to detract from our ability to deliver the support that these countries need. For most of us today, the trade-offs are between we talk about the economy and health trade-offs in rich countries. And then if you think about what is the consequence of this same conversation in low-income countries, basically most households have no capacity to draw down their personal reserves. So for them, the trade-off really is one that actually, as some prime ministers in developing countries have put it, they are going to be facing starvation soon. Unless we can get some support to them. So I think that is an important point that we need to just recognize.
Thanks, Masood. And let me ask, starting maybe with Brad and Scott, if speaking to these bilateral sources, let's say U.S., China, UK, what's the list of to-dos? You talked about they need to act on the board to make sure that there's the adequate, as most money that's available, that all their instruments are being used. You talked about the bilateral lines at the IMF that need to be renewed. We talked about a need for additional concessional financing. Could you sort of give us the 4 or 5 bullet points that those member countries need to have on their agenda going into the next weeks? Brad?
So I think I'll focus on what they can do as creditors themselves and what they can do through the IMF. The U.S. and China have already extended a set of government-to-government loans to a range of countries, China more so than the U.S. Right now, though payments on existing loans should be rescheduled so that countries don't have to use limited financial resources to repay long-term loans to fellow governments. So I think that's something that is easily within the capacity of most governments. Rescheduling existing credits doesn't mean recognizing a loss. It just means recognizing that payments cannot be paid now. The U.S. and China and others should be working very aggressively to expand the IMF's lending capacity so that it can deliver as much as possible. One way they can do so is that the new arrangement to borrow, which now provides, let's say, 225, maybe 250 billion, depending on the exchange rate of lending capacity, is scheduled to double in size at the end of the year. The U.S. already has approval to raise its contribution to the new arrangement to borrow. The IMF, all the shareholders should be working together to pull that lending capacity forward. They should also maintain bilateral lending commitments, which were scheduled to fall at the end of this year, at their current level. Bilateral lending is additional credit that countries that have the capacity have provided to the IMF so that the IMF can then lend it out. That capacity is scheduled to fall from 400 billion to under 200. We should be working to keep it at the 400 billion level. That's how you expand the envelope without making any radical shifts in the structure of the institution. And those are things that can be done quickly. Finally, I think the U.S. should support an SDR allocation of 500 billion, which gives about 200 billion to developing countries and gives a substantial amount of additional reserves to the United States as well, at a time when the U.S. is using its existing reserves to backstop money market funds. I think that's actually helpful to the United States. This is a time when I think the advantages of giving everyone additional reserves are quite significant, and the drawbacks are small. In the face of a common shock, a common response seems to be called for. So between those sets of measures, I think the U.S. and the other major shareholders can meet a substantial part of that $2 trillion plus need that Masood has mentioned. Thanks.
Excellent,
So,
Brad. And go ahead, Scott.
Yeah, so just on Amanda, I would say three things. The first is just to strongly endorse what Brad said about the role of bilateral creditors and certainly rescheduling. I think there's still a bigger conversation about the role of debt relief, and alluding to Masood's earlier remarks on that, I think it's important to really think it through before jumping in aggressively as you know, in terms of top of list, and we can come back to that. Number two, I think, you know, particularly for the large countries, really taking coordination seriously in terms of joint actions through the international financial institutions. And again, this comes back to the role of the G20. And I think to date, the statements have been a disappointment. I don't think they've been a disaster. I guess my optimistic take is that this is, you know, they're still buying themselves time to work through what the bold statement will look like. And I hope that comes in the form of an action plan. But you really do. So if we, you know, come back to that $1 trillion number for the MDBs, the MDBs are not going to self-coordinate on that. The management of the institution, it really is for these large countries to drive that kind of coordinated high-level response. So I think that's really critical, and you know, you effectively do need the G20 to do that, because the G7 doesn't have China at the table. You need China at the table, not to mention other large emerging markets. And then finally, I think there is a role in forward funding sort of the donor money that is going into the institutions. So these are existing commitments, whether it's something like the IDA replenishment at the World Bank. You know, I was very pleased, and I think the U.S. administration and the Congress deserve credit for expediting the authorities that are needed. That included the new arrangements to borrow at the fund. That, you know, that's why we're in this good position for the U.S. is that Congress took that on. I think as a next step, it would be good to see them move forward as quickly as possible with what would otherwise be sort of a later in the year annual funding commitment. And then another part of that, and this falls in the category of some things are actually easier to do in a crisis than in normal times. The U.S. Stands alone among donors to these institutions in not being current with its commitments. And there's this body of funds that we call arrears that are essentially past due that have accumulated over many years, now over $2 billion. This is a very good opportunity to put that money into the institutions at a time when it is needed and can be spent effectively, and then deals with a long-standing headache. Arrears are an issue across the multilateral system. I think it's a good opportunity in a crisis period to break through all of the sort of the petty politics of that and just get it done.
Thanks, Scott. Just to drill down on this, the idea of extending the government-to-government loans, David Malpass and Kristalina Georgieva called on bilateral creditors in the same sense. They talked about a moratorium on debt payments and even outright debt forgiveness, and that call has been echoed by a number of non-governmental organizations. On the other hand, you've spoken about the priority being really cash into these systems as quickly as possible. Is debt relief and forgiveness the way, or is it about rescheduling and extension? Can you just be very explicit on that? And what would you say to the advocacy community in this space? Brad?
Sorry, could you repeat that? I was looking at some of the questions.
Sorry, or maybe I'll ask Scott to start. You've talked about extending the terms of the government-to-government loans, rescheduling the debt. On the other hand, we've also heard calls for a moratorium on debt payments or outright debt forgiveness. this is a bit of a continuum of measures. What exactly is it that we think is the right way forward? What do you see as the right way forward? What would you like to see advocates asking for if all of our goals is to get more money into these systems as soon as possible?
So yeah, I guess I'll go first. Just to say, and Brad laid out in his initial remarks that particularly for the bilateral creditors, rescheduling just really is important and useful right now. And I think it's important to recognize for the lower income countries, this is the largest single category of creditor for their external credits. That is where the money is. The multilateral institutions as well, but it actually has been the bilaterals in recent years that have emerged. China is a big driver of that, so a lot of this falls to China. But I think, stepping back in the bigger picture on the debt issues, number one, I think we should recognize, particularly for the lower income countries, when we sort of throw around the idea of broad-based debt relief, actual debt forgiveness, this is a very different context than prior, the so-called HIPC initiative, which was dealing with long-term structural issues for these countries in what was otherwise not a crisis period, certainly in the global economy. And it was a very sort of slow-moving, cumbersome process that entailed a lot of conditionality, the kinds of things Masood was alluding to that, frankly, you don't want to take on in a crisis period. So I think there's sort of this overriding imperative to recognize what are the measures and instruments that will get money out quickly. If you can, quick debt rescheduling falls in that category. Alleviating immediate payments, yes. What I worry about, and as much as I like that the heads of the bank and the fund were out there with this call, if it becomes sort of a dominant top of list thing, it quickly snowballs into a broader effort to pull in the multilaterals themselves, which is a very complicated endeavor of how do they write down debt in a way that doesn't impair their ability to lend new money right now, bringing in the bondholders and negotiating with private creditors around this stuff. Those are all challenging things. I worry that to take on that full package of actors and measures becomes overly cumbersome and sort of loses the target of how are we maximizing financing for these countries today. But all of that said, we have to recognize what is probably the inevitable. Even before this crisis, a majority of low-income country governments were either at high risk of debt distress or were in debt distress. So this has been a growing problem already for these countries, and it's not going to get any better.
Nancy or Brad, did you want to add to that, or shall we go on to the next question?
I'll add a couple of quick thoughts. The first is to reinforce something that Masood said, which is focus on what needs to be done now, and don't let problems that have to be solved eventually get in the way of solving problems that can be solved now. So the bilateral creditors can just agree proactively and preemptively to reschedule all payments coming due. That achieves much the same effect as a broad moratorium. It does mean that payments are being deferred. Some interest is being added to your stock of debt, and there will be countries that won't be able to repay that. But we can sort that out, in my view, later. We don't know where the long-run price of oil is going to be. We don't know where the long-run price of many commodities will be. We don't know how rapidly global trade will recover. Those are all important variables to assessing long-term repayment capacity. So in the short run, push payments out. And if there are problems that emerge, solve those problems later. The usual disadvantage of just deferring payments is that it makes it harder to attract new inflows. But in the near term, new inflows are going to come from preferred creditors like the IFIs, who can afford to take risk. And realistically, private markets aren't going to be able to supply much funding over the next couple of years. So the usual arguments for sorting out long-run debt capacity aren't as pressing right now. There's exceptions. Argentina, Lebanon are already in debt restructurings. They need to accelerate those private debt restructurings or just accept an extended period of non-payment. But in general, take advantage of the fact that bilateral creditors can push out payments, and the cost of doing so from their balance sheet point of view is very low.
Just to add, let me add one thing to that, to what Brad said, Amanda, which is if you look at the magnitude of payments owed by low-income countries to the various creditors, the multilaterals, the bilaterals, and the private sector, the single largest chunk of debt service is actually to the bilateral creditors. Even though the debt stock for multilaterals is bigger, since so much of that lending is concessional, the debt service is actually lower. So to add to the logic or the rationale for this, it is the single largest source of debt payment relief that you could provide to at least low-income countries.
Thanks. I think that makes the situation quite clear. Now let's turn to some of the questions that have come in via the audience. Let's start with a colleague from the International Fund for Agricultural Development who has talked about, I mean, I think we've dealt with some of this, but he's asking, we're asking the major donors to the IFEs to take some additional measures. Some of them are don't give much of a hit to our own bottom line. But he's asking, with so many donors facing severe crises themselves, what are other options that could allow multilaterals to avoid asking the usual suspects to open up their wallets? I think we've talked about this, but is there anything else you would want to add about what should we worry about if the biggest sources of funding into the IFEs are the usual suspects and they are themselves under an enormous amount of fiscal pressure? I think we've outlined a great plan that makes it quite feasible without huge outlays, but is there a point at which we start to worry about that issue? Is it within a year or is it sooner than that?
Can I just come in on that, Amanda? Just to say, look, yeah, there will be a point where these institutions will need resources, but two things to remember. If as Brad and others have reinforced, it's not right now. So let's start that conversation on a somewhat slower track, and we'll come to that in a year or 18 months. And the second thing is, remember, the markets are becoming very risk averse. And in a risk averse world, these institutions are very attractive places to which people with assets want to lend. So they will be able to borrow at attractive terms for a long, long time. And so there's a lot of money that was previously going directly to emerging markets, which is going to be pulling out of there, but will be looking for places like the MDBs and others to lend to. And then I would say that the final thing on that is that they can borrow, and we can think about how they can borrow, but ultimately there will need to be a reckoning in terms of the call on public capital in the rich countries of the world to be able to share more of the cost for dealing with the consequences of this crisis, not just at home, but internationally over time. So a lot of what we have been talking about are ways in which you can provide additional financing without an immediate call on the capital of the public budgets of the rich countries. And that's fine for now, because right now we need to get the money out, and the rich countries themselves, most of them are struggling to deal with the pandemic itself. But down the road, we shouldn't kid ourselves that one consequence of this will not be that the rich countries will need to think about how they can put in some more public capital, either to shore up the capital base of these institutions or to provide direct financing in the form of grants, because or to help deal with some of the costs of any debt relief that is coming down the pike. So I think that is just, we're parking that for later, but we shouldn't leave the impression that there's no consequence.
Well, and I think we should also note that there are 3 replenishments of concessional financing facilities that were scheduled for 2020 that are also really important. So the Gavi Alliance that provides vaccines for children in low-income countries, IFAD itself, the Asian Development Fund. So there are those asks. And then there's an ask, obviously, from the UN system for the humanitarian response. Those add up to, what, $5 to $6 billion. Do you foresee an issue, or are some of these stimulus efforts going on in the higher income countries going to be sufficient to address these replenishments that are also vital in putting together that big number that you talked about, especially for low income countries?
I think that these are at different stages, right? So the replenishments of Gavi and IFAD are coming along, and I don't see any reason right now why the current pandemic would slow down the willingness to respond and complete those replenishments. I think, if anything, it's going to give added impetus to complete them. UN ask is a different kind of ask. The UN ask essentially is putting together what the world needs to be able to respond to this crisis on the one hand, and how much of that could usefully go through UN organizations, either in the humanitarian space or more generally to support developing countries. And that's where I think the challenge will be to keep the donors to the UN system committed to supporting that set of channels, based on the recognition that in the middle of a crisis, many UN organizations are best placed to provide the kind of field delivery of relief that bilateral organizations are going to be harder put to do, because many of them are actually pulling back right now their own stuff. So it's very hard for them to be able to provide the support. The UN is always much easier, much more likely to be in the front line in difficult situations.
Thanks. Nancy, we received a question that asks about the issue of the DFIs and their role in this space. It asks, an important proportion of blended finance has been targeted to the infrastructure sector, but considering COVID, should blended finance focus now on other sectors? That's from Rasik Nyembro.
I would say, as a general principle, the purpose of DFI finance to the private sector at this stage is a macroeconomic purpose. It is essentially to help sustain demand and supply through ensuring some level of financial intermediation in these countries. So you basically need lending to, micro, small, medium enterprises generally. And I would say you need to continue as much as possible the infrastructure investment that includes some private participation, because that's a source of demand, construction demand and other demand. So what you're trying to do is sustain the financial flows in order to sustain some level of income generation and demand. Having said that, however, you do want to use the private sector to do the kinds of things that the private sector does well. And one of those things is to innovate, to get goods and services to people that otherwise might not get them. And that could include health services. So remote populations, excluded populations that the public health systems are not reaching in low-income countries could benefit from firms, innovative firms that are able to provide these some health services, maybe not COVID-19 health services, but other health services through, new kinds of distribution channels, drones and other things that the private sector is well placed to create new business models that can provide the better service delivery. So I would say the main focus should be macro, but a sort of innovation in key services is also a key part for blended finance.
Hey, Amanda, can I just one other thought on that point? Because I think there's still an unanswered question, particularly for the MDB. So, thinking of infrastructure as a long-term investment activity for these countries, and it is still the single largest thing that the MDBs do with their partner countries. I think the unanswered question is, in this crisis moment, how prepared are these institutions to figure out consumption and channeling money toward consumption activities on a large scale? Because I think I think one of the things we saw in the global financial crisis was, we were pulling forward, we are expediting existing projects in the pipeline. But if these are projects that, that still have sort of a 10-year timeline to them, I'm not sure that that's the right priority. And I think, again, in Masood's remarks, he talked about things like cash transfers, but then thinking through the challenges of limited coverage of those. I think there's a really difficult set of questions that I hope the institutions are trying very hard right now to figure out. One of the answers to it is, what we would expect is to see a shift toward a lot of budget support coming from the MDB, so not doing project lending. But even that in turn depends on then those governments having some ability to program that money toward social safety net effectively on a broad basis.
I think you're starting to go, and we're having some questions on sort of the use of those funds that would go into low and middle countries. There's a question about how all of this intersects with governments that are weak or fragile by internal strife. We're talking about Libya, Central African Republic. I mean, what would you watch for? What kinds of measures could be taken? There's also some questions about how could the IFIs help with the issue of job losses, how to decide between spending within the health sector versus the safety net. Do you have any thoughts on that as a group?
Yeah, can I just say one thing on that, please, Amanda, which is, the really urgent priority now would be to sit with each country, just as we do after a natural disaster, and you come up with a disaster recovery plan. We really this is the moment for the international community to be sitting and helping each country come up with a plan to shore up incomes and to keep the economy going as best as they can under the circumstances. And the mix of measures is going to differ from country to country depending on where they start from. So if you take the fragile states, it's going to be the hardest there because in those countries, for example, governments are less likely to be trusted. They're less likely to have a structure to be able to get income support out to individuals, and maybe people have to rely on very unorthodox measures. You might put a moratorium on the payment of electricity bills for the poorest, for the people who consume the least amount of electricity. Take some bar like that, and that's the kind of thing that, in normal circumstances, I would be very uncomfortable recommending, and most institutions would be very uncomfortable supporting, because it actually is one of the reasons why we have these chronic budget deficits in a lot of state enterprises in countries. But in today's world, I guess we have to really be willing to explore what works in the country context rather than go in with a package of here are the 5 things that every country has to adopt, because those 5 things are going to be very different country to country.
And I mean, the other point, one question also is that should money go through government only, or should we think about other kinds of organizations that can execute in fragile countries or in places that don't have much government activity that's effective? One of our audience, Sasugo Dose, asked about how is it that non-governmental organizations in these countries are going to be able to continue working without some government support for that use. There was also a
Can I
question
just,
from our, go ahead. Mm-hmm.
that I was just going to add on that very point. What you want to do is reach, if you're going to reach non-governmental organizations or non-governmental companies, you want to reach, you want to target the institutions that reach a lot of people. So one of the things you can do is work with the microfinance sector in countries. Even fragile states often have microfinance sectors of some kind, commercial or non-commercial. They reach a lot of people at the base of the pyramid. And so you could imagine some kind of innovative ways of using institutions like that, some sort of government support or some sort of international support for debt relief for microfinance clients, for example, that would get relief to a lot of people quickly. That's certainly something that, for example, in the Haiti earthquake, the microfinance sector was a key way to get relief out to a lot of people at the same time.
Okay, thanks, Nancy. Our colleague Charles Kenny, following up on some of the earlier conversation, asked, alongside general economic support, is now the moment to guarantee pledges to the Gavi Alliance and or other agencies good at procuring equipment in bulk so that we know there is, say, $20 billion to purchase COVID vaccines for the lowest income countries as soon as they become available? Obviously, we've mentioned that there's a replenishment, but that replenishment is based on the old number of low-income countries. We might see countries slip from middle income back into low-income status. That's one possible thing that could happen. And then we also need them to purchase the vaccine in bulk. So how would you think about that? It is a different order of magnitude of financing, and we haven't really talked about that. Scott, Masood?
I think that, Amanda, I think that's a question that you should answer for yourself.
I was going to say, you're best placed to answer it.
And can I add a follow-up
Excellent.
question to you, Amanda, which is,
Okay, go ahead.
I think, we finally maybe come around in our own country to understanding that the health crisis is the economic crisis in a sense. I mean, that you have to address it definitively and first. But for low-income countries, how are we to think about that? And and even for the MDBs and this sort of constellation of health funds and actors, how much should they be sort of pushed to the forefront? That really it's about whatever COVID response can look like in those countries, and recognizing that's even a more challenging task.
Yeah, I think we'll be scheduling a follow-up session to discuss some of those issues. But we certainly can see that the resourcing that we are currently providing is insufficient to be able to secure a vaccine for IDA countries. And as you're saying, the high-income countries aren't going to be done with this outbreak until all countries are done with this outbreak. So we really do need to address these issues everywhere in the world as much as we can. And it's not particularly expensive. And then the other thing we need to think about is what are the kinds of structures and architecture for global health that we need going forward to prevent something like this happening again. We'll do another event, Charles, but thanks for your question. There is a last question related, and then we'll wrap up. A question about what would be the effects of extending debt repayment terms, whether it's the IFIs or others. Would it affect credit ratings? Are we creating a space where vulture funds would come in? I think what I heard Brad say is now's not the time to deal with that problem. We'll deal with that in the future. But can you give us your sort of last take-home comments based on our conversation so far? We'll start with Brad.
Well, look, I think as Masood has mentioned, right now the world is looking for relatively safe assets. Even if the MDBs take some balance sheet risk, their structure, the backing of the world's governments, will make them a safe asset. they will continue to be a safe asset, even with some riskier exposures, so long as they are backed by the collective strength of all the major economies around the world. So I don't think we need to worry too much about the risk that the IMF and the World Bank are taking. Similarly, countries, bilateral creditors that extend the maturity on their loans, they should hold those loans on their own balance sheets. They shouldn't sell them to third parties. And that way, enforcement remains in the hands of governments, not in the hands of aggressive creditors. Third point here is that there will be some defaults on private bonds. There will be cases when it would be in the interest of the current holders of those bonds to reach agreement quickly with their creditors to extend repayment voluntarily, to cure the default, and that would address the risk of vulture litigation. But I would also note that right now, our courts should not be rushing to enforce claims against sovereigns in distress. There have been changes that have been made that should slow the rush to the courthouse. The simple fact that it is so hard to meet in person should slow the rush. And I think the U.S. Treasury should be pretty clear in filing briefs to the courts saying that now is not the time to support innovative strategies for collection on defaulted claims. Combine those measures, and I think we can manage these risks. Thanks.
Thanks, Brad. Scott?
Yeah, the only thing I wanted to add is that I would take Brad's second point and put that language directly in a G20 leader statement. It's exactly the kind of commitment that is specific and meaningful. So we commit to extend, restructure our bilateral credits and to hold them on our books. They can do, if the G20 does that, yes, there will be other bilateral creditors out there, but you've captured the vast majority of those credits, and it would be a meaningful commitment. So I think that would be great to see.
Matt, could I just say one final point? Look, we're in the middle of a global crisis, and it's always tempting to say, well, what's the silver lining? Is there something you can see, something good that could come out of this crisis? And it's a little trite right now to be saying something good will necessarily come out of it, but it is a stark reminder of, if we needed one, of how much our world is interconnected in ways that we hadn't anticipated and in ways for which we hadn't set up the structures to manage them. In November of 2017, Larry Summers, who's the chair of the board of CGT, spoke at our annual event. And I remember vividly an analogy he used, which was to say that the WHO budget for pandemic flu was somewhat less than the annual salary of the Michigan State football coach. And, you sort of look back on it today and you see that what we are now paying is the gross underinvestment in a system to support and manage global public goods and global public bads. And if there's one lesson that we learned from this exercise, is that going forward, we have to invest in the ways in which these global effects can be better managed than we've been able to do. And in doing that, we have to recognize that whatever the bilateral relationships between countries, whatever the relationship is between the United States and China, for example, going forward, the only way we can manage common problems like pandemics, like climate, is by finding ways to work in a common framework to deal with them. So I guess that's a conversation we're going to have down the road. But I do want to say that this is a stark reminder of the degree to which we've become interdependent and the extent to which we need to manage that.
Great. Well, I think unless others have final words to add, that seems like a good place to end this session, with thanks to all of you online for joining us, and to promise that our audio will be better in the next round. And really to thank very much the panelists, and especially Brad, who joined us. Your clarity is hugely appreciated, and you can read more of Brad's stuff on his site over at the Council on Foreign Relations. But thanks to everyone, and we'll be having some more soon, also from the perspective of the health sector. So thanks very much for joining, and stay healthy. Bye.